Welcome to Validea University. In this series of short videos, we will discuss some key investing concepts that impact investors today and distill them down into their most important components. In today's video, we discuss the basics of momentum investing. At a high level, momentum investing involves buying things that have gone up. Momentum can be counterintuitive to many investors, since we all have a tendency to want to buy things that are on sale, but academic research strongly supports the fact that momentum works. Along with value, momentum is the investing factor with the strongest long-term evidence to support it. Momentum doesn't work over all periods, though. It works best over the intermediate term, which in general is 3 to 12 months. It does not work as well over longer or shorter periods. There are two major types of momentum. Cross-sectional momentum involves comparing the price movement of an asset to another asset. For example, if stock A has a greater return over the past year than stock B, and I use that fact to invest in stock A, that is an example of using cross-sectional momentum. The second major type of momentum is time series momentum. This involves comparing the price of an asset to itself and selling or reducing exposure to that asset when the trend is negative. Trend following is a common example of this. There are several common ways to measure momentum. For cross-sectional momentum, the most popular is relative strength. This measures a stock's performance against all other stocks and assigns a score of 1 to 99 based on how well it has performed, with 99 being the highest score. Another common metric used in academic testing for momentum is called 12-1 momentum. This measure calculates the return of an asset over the past 12 months, but excludes the most recent month from the calculation. This is done because short-term momentum tends to mean revert, so calculating momentum this way eliminates short-term stock price movement and focuses on the intermediate term. For time series momentum, the most common metrics are moving averages. Moving averages are calculated by taking all of a stock's prices over a specified period and averaging them. For example, a 200-day moving average is calculated using the average closing price for a stock over the previous 200 trading days. Moving averages are often used in trend following as an indicator for when to get into or out of an asset. For example, a simple 200-day moving average strategy applied to the S&P 500 would sell it when it falls below its 200-day moving average and buy it back when it moves back above it. Research has identified a couple of other factors to keep in mind with momentum investing. The first is that momentum tends to work better when it is consistent. This means that stocks whose price movement looks more like a straight line typically perform better going forward than those that have more volatile returns. In their book Quantitative Momentum, Wes Gray and Jack Vogel found that adding a measure of momentum consistency improved the risk-adjusted returns of momentum strategies. The second factor that is included in some momentum strategies is fundamental momentum. Fundamental momentum applies the same concept as price momentum to a company's actual reported financial results. In his paper Twin Momentum, Dashan Huang found that adding a measure of fundamental momentum to a price momentum strategy doubled its excess return. When looking at momentum investing, it is also important to examine why it works. While there is debate as to why momentum works, the explanations typically fall into two categories. The explanation is that momentum takes more risk than the market, and investors receive a higher return as compensation for that risk. Momentum stocks can be more volatile than the market, and investors receive an excess return as compensation for enduring that volatility. The second reason is that investors sometimes systematically misprice stocks, and momentum can take advantage of that. There are several explanations as to how this might happen. The first is that investors tend to underestimate good news about companies in the intermediate term, and so they underprice momentum stocks. When the market realizes this mispricing, it drives up the price of momentum stocks and delivers an excess return for momentum investors. Another explanation is reflexivity, which in simple terms means that good things lead to other good things. As an example, if a company's stock does well, it can use that higher price to issue stock and fund its business. It is also more likely to attract top talent, which helps it continue to grow. There is no one answer for why momentum works, but academic research shows that it has worked across many markets and asset classes and over long periods of time. This concludes our look at momentum investing. We appreciate you taking the time to watch the video. To find out more about Validea, you can follow our Validea Vids channel on YouTube. You can also follow us on Twitter at GuruInvestor. To read our investment commentary, you can go to our blog at blog.validea.com. To take a free trial to our subscription product, which includes the 22+ factor models we run, you can go to our research website at www.validea.com. Thank you for watching.